Before we begin, it's essential to state that the information provided in this video is for educational and informational purposes only. I am not a licensed financial advisor or certified insurance professional. This presentation is not intended as a substitute for professional advice. You should always consult with a qualified and licensed professional for advice tailored to your specific situation before making any decisions about your insurance coverage. You're overpaying for car insurance. I can say that with about 90% certainty. You're likely paying hundreds, maybe even over $1,000 more than you need to every single year for a policy you don't even fully understand. How do I know? Because the entire system is designed that way. It's a deliberately confusing world of acronyms, legal jargon, and hidden clauses, all designed to do one thing: separate you from your money while making you feel protected. Think about it. You get into a tiny fender bender in a parking lot. You do the right thing, you exchange information, you call your insurance company. And that's when the trap springs. Suddenly you're hit with a 4-figure deductible you barely remembered agreeing to. You spend weeks going back and forth with an adjuster who seems to be speaking a different language. And then the final insult arrives in the mail 6 months later. Your premium has skyrocketed by 30%. All for a tiny dent that barely cost anything to fix. You feel powerless. You feel cheated. This video is the antidote. This is your masterclass in decoding the American car insurance industry. We are going to arm you with the knowledge they hope you never find. We're going to answer the top 10 questions every single American asks about their car insurance. The questions that keep you up at night after an accident. The questions you're too afraid to ask your agent because you don't want to sound clueless. We'll cover everything from how to slash your premium without sacrificing coverage, to what to do in the first 5 minutes after a crash, to whether those new pay-per-mile insurance plans are a brilliant savings hack or a total scam. By the end of this, you will not be a victim. You will be in control. You will understand your policy better than 99% of drivers on the road, and you will know exactly how to get the best possible coverage for the lowest possible price. So let's get straight into it with the single most important question of all, the foundation upon which everything else is built. Question number 1. How much car insurance do I actually need? The answer you've probably been given is, whatever your state requires. And that is, without a doubt, the single worst piece of financial advice you could ever follow. Relying on your state's minimum insurance requirement is like trying to put out a raging house fire with a squirt gun. It is a financial suicide mission waiting to happen. Let's break down why. Every state has a minimum liability coverage requirement. This is the insurance that pays for the damage you do to other people and their property. It's usually expressed as 3 numbers, like 25/50/25. This might be the requirement in your state. It looks official, it sounds like enough, but let's translate what that actually means. The first number, 25, means your insurance will pay a maximum of $25,000 for a single person's medical bills if you injure them in an accident. The second number, 50, means the absolute maximum they'll pay for all medical bills combined, no matter how many people you injure. And that third number, 25, is the maximum they will pay for all property damage you cause. That means the other person's car, their laptop that was in the trunk, the mailbox you hit, the fence you crashed through. Everything. Now let's apply that to the real world. You're driving down the highway, you glance at your phone for 1 second, and you rear-end a brand new Tesla Model S. Pretty common car these days. The average repair cost for a minor rear-end collision on a Tesla can easily exceed $20,000. But let's say it's a bit more serious. The trunk is crumpled, the battery sensors are damaged. The bill comes to $40,000. Your state minimum policy covers just $25,000 of that. Who pays the remaining $15,000? You do. Out of pocket. Your savings account? Gone. Your emergency fund? Wiped out. Don't have the cash? They can and will sue you for it. They can get a judgment against you, garnish your wages, and put a lien on your house. Your financial life can be ruined for years, all because you followed the state minimum. And we haven't even talked about the medical bills. What if the driver of that Tesla has a back injury? A single night in the hospital, an MRI, and a few weeks of physical therapy can blast past that $25,000 bodily injury limit before you can even blink. If there's a passenger, that $50,000 total limit is a joke. Serious accidents can result in hundreds of thousands, even millions of dollars in medical costs. So what's the real answer? How much do you actually need? While it depends on your personal assets, a much safer baseline for the average American driver is what's often called 100/300/100. Let's translate that. $100,000 for a single person's medical bills, $300,000 total for all medical bills in an accident, and $100,000 for property damage. This single change provides a powerful shield around your financial life. That $100,000 in property damage coverage means you can total a brand new Mercedes or a luxury SUV and not have to personally pay a dime. That $100,000/$300,000 in bodily injury coverage means you're protected from the vast majority of injury claims that could otherwise bankrupt you. And here's the kicker. The price difference between the pathetic state minimum and this robust protective coverage is often shockingly small. We're not talking about doubling your premium. We're often talking about an extra $15, $20, maybe $30 a month. It is the single best investment you can make. You're paying a few extra dollars a month to protect yourself from a potential $500,000 lawsuit. It's a no-brainer. But liability coverage is only half the story. Protects everyone else from you. What about protecting you and your car? That's where the other two main types of insurance come in. Collision and comprehensive. Collision is simple. It pays to repair or replace your car if you hit something. Another car, a pole, a guardrail. If you cause an accident, this is the coverage that fixes your vehicle. Comprehensive, or comp, is often called act of God coverage. Covers almost everything else. A tree branch falls on your car during a storm. A deer jumps out in front of you on a country road. Your car is stolen. Hail turns your hood into a golf ball. A rock cracks your windshield. All of that is comprehensive. Now, do you need these? If you have a loan or a lease on your car, the answer is yes. Your lender will require you to have both. It's not optional. They want to protect their investment. But what if you own your car outright? What if you're driving a 12-year-old Honda with 150,000 miles on it? This is where you have to be a smart consumer. The general rule of thumb is this. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, it might be time to consider dropping it. For example, if your car is worth $4,000 and you're paying $500 a year for comp and collision, you're paying over 10%. At that point, it might be smarter to bank that $500 a year in a dedicated car repair or replacement fund. You're essentially self-insuring. You're betting that you won't have a major at-fault accident, and you're saving the money instead. So to recap question number 1, how much insurance do you actually need? First, forget the state minimum. It's a trap. Second, make your liability baseline at least $100/$300/$100. If you own a home or have significant savings, you should consider even higher limits or an umbrella policy. Third, if you have a loan or lease, you need collision and comprehensive. And fourth, if you own an older, low-value car, do the math. Calculate if paying for full coverage is still worth it, or if it's time to save that money yourself. Mastering this first question puts you leagues ahead of most drivers. But it immediately brings up the next, equally critical question. We've covered liability, collision, and comprehensive, but we've all seen that long list of optional coverages on our policy. Things like medical payments, uninsured motorist, rental reimbursement, and roadside assistance. Are these essential protections or just expensive add-ons designed to pad the insurance company's profits? That's exactly what we're going to expose next. So let's pull back the curtain on these so-called optional coverages. Think of your basic liability insurance as the concrete foundation of your house. It's non-negotiable. But these other coverages, they're the walls, the roof, and the alarm system. And living in a house with just a foundation during a storm is a terrifying and financially catastrophic idea. Let's start with the one that deals with the most important thing inside your car. I'm talking about medical payments coverage, or MedPay, and its more comprehensive cousin, personal injury protection, or PIP. The sales pitch is simple. If you or your passengers are injured in an accident, this coverage helps pay the medical bills, regardless of who was at fault. Now, your first thought might be, wait a minute, I have health insurance for that. And that's the exact thought that leads millions of Americans into a devastating financial trap. Here's why. Imagine a seemingly minor fender bender. The other driver admits fault. You feel a little shaken up, maybe your neck is sore. You decide to get checked out at the ER just to be safe. The doctor says you have some whiplash, gives you a neck brace, and sends you home. A few weeks later, the bills start arriving. The ambulance ride, $1,000. The ER visit, $2,000. The x-rays, $500. Your health insurance has a $5,000 deductible, so you're on the hook for the first $3,500. You think, No problem, the other guy's insurance will pay for it. He was at fault. But his insurance company is dragging its feet. They're investigating the claim. They want recorded statements, police reports, medical records. This can take months, sometimes even years. Meanwhile, those medical bills are due now, and they're going to collections, destroying your credit score. This is where MedPay or PIP becomes your financial superhero. It pays those bills immediately. There's no waiting for fault to be determined. There's no deductible. Just pays. It's a fund you can tap into instantly to cover the ambulance, the ER visit, the copays, the physical therapy, all the things your health insurance might make you pay for out of pocket first. And crucially, it covers your passengers too. What if your friend in the passenger seat doesn't have good health insurance? Are you comfortable letting them get stuck with a mountain of debt because they were riding with you? In some states called no-fault states, PIP is actually mandatory because they recognize how vital this immediate protection is. PIP is even better than MedPay because it can also help cover lost wages if your injuries keep you from working. So is it just an expensive add-on? For the price of a few fancy coffees a month, you get immediate access to thousands of dollars to protect your health and your credit score. It's not an add-on. For most people, it's an absolute necessity. But as critical as MedPay is, it pales in comparison to the next coverage we need to talk about. This is the one that I believe is the single most important piece of insurance you can buy, period. And it's the one most people tragically misunderstand or decline to save a few dollars. I'm talking about uninsured and underinsured motorist protection. Let this sink in. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States has no car insurance. 1 in 8. On your morning commute, you will likely pass dozens, if not hundreds, of these drivers. They are ticking financial time bombs. If one of them makes a mistake, runs a red light, texts and drives, veers into your lane, and hits you, their lack of responsibility suddenly becomes your catastrophic problem. Let's say an uninsured driver T-bones you in an intersection. The crash isn't your fault, but your leg is shattered, you need multiple surgeries, and you can't work for 6 months. Your medical bills climb to $100,000. Your lost wages are another $30,000. Your car is totaled. Who pays for this? The other driver? He has no insurance. You can sue him, sure. But if he couldn't afford a basic insurance policy, what are the chances he has $130,000 sitting in the bank? You can win a lawsuit and get a piece of paper saying he owes you money, but you'll likely never see a dime. This is where uninsured motorist coverage saves you. It steps in and acts as the insurance the other driver should have had. Pays for your medical bills. Pays for your lost wages. Can even compensate you for pain and suffering. It protects you and your family from being financially ruined by someone else's irresponsibility. And what about underinsured motorist coverage? This is just as important. Many people who do have insurance only buy the absolute legal minimum required by their state. In some states, that might be just $25,000 for bodily injury. If your medical bills are $100,000, that minimum policy is like trying to put out a house fire with a water pistol. It's not enough. Underinsured motorist coverage kicks in to pay the difference between the other driver's pathetic limit and the actual cost of your injuries, up to the limit you selected. Declining this coverage to save $10 or $15 a month is one of the biggest gambles a person can take. You are betting your entire financial future, your house, your savings, that you will never, ever be seriously injured by one of the millions of uninsured or underinsured drivers on the road. It is a bet I would never ever make. This isn't an add-on. This is a shield for your family. Now let's shift gears to something a little less dramatic, but incredibly important for your daily life. Rental reimbursement. This one's simple. If your car is in the shop for repairs after a covered accident, this pays for a rental car. Is it essential? Well, answer this question. If you woke up tomorrow and your car was gone for 3 weeks, could you get to work? Could you take your kids to school? Could you buy groceries? If you have a second car, or you work from home or have great public transportation, you might be able to get by. But for the vast majority of Americans, being without a vehicle for an extended period is a logistical nightmare. And don't assume repairs will be quick. With ongoing supply chain issues, a simple part for your bumper could be on backorder for weeks. A rental car can easily cost $50, $60, even $70 a day. Over 3 weeks, you're looking at a bill of over $1,000, all because of an accident that might not have even been your fault. Rental reimbursement coverage typically costs just a few dollars a month. You do the math. Is a guaranteed ride worth the price of a bag of chips? For most of us, this isn't a luxury, it's a lifeline to keep our lives running. Finally, let's talk about the one everyone knows: roadside assistance. This covers the classic car troubles: towing, a dead battery, a flat tire, locking your keys in the car. It's the ultimate convenience coverage. But is it a necessary add-on from your insurance company? The answer is maybe not. This is the one area where you might be double paying without realizing it. Many people already have roadside assistance and don't even know it. Do you have a AAA membership? You're covered. Do you have a premium credit card? Check the benefits. Many of them include roadside assistance. Did you buy your car new? Most manufacturer warranties include it for the first few years. Before you add this to your policy, do a 5-minute audit of your other memberships and warranties. If you're already covered, there's no reason to pay for it again. But if you're not, adding it to your insurance is often the cheapest way to get it, and a single tow service, which can cost well over $100, will more than pay for an entire year's worth of the premium. So, are these coverages just profit-padding add-ons? The answer is a resounding no. MedPay is your immediate medical shield. Uninsured motorist is your financial fortress against the irresponsible. Rental reimbursement is your guarantee that your life doesn't grind to a halt. And roadside assistance is your safety net for the unexpected. They aren't side dishes. They are essential ingredients for a truly comprehensive policy that actually protects you. Now that you understand which coverages you need to build your policy, you're faced with the next giant question, the one that directly controls how much you pay every month: the deductible. Your agent asks if you want a $250, a $500, or a $1,000 deductible. Choosing the low one feels safe, but your premium skyrockets. Choosing the high one saves you a ton of money. But are you setting yourself up for a massive out-of-pocket bill you can't afford? How do you find the sweet spot? Is there a secret mathematical formula to picking the perfect deductible? That's what we're exposing next. The truth is, there is no magic number. There's no secret formula written on a stone tablet that says, the perfect deductible is $1,000. Anyone who tells you that is lying. But there is a secret framework, a 3-step process that will lead you to the perfect deductible for you. And once you learn it, you'll never be confused again. It's the difference between financial peace of mind and a potential catastrophe. To understand this, let me tell you about two people. We'll call them Dave and Jessica. Both are 30 years old, drive similar cars, and live in the same city. They're both looking for new car insurance, and they both want the lowest possible monthly payment. Dave goes online, plays with the numbers, and sees that if he jacks his deductible up to $2,000, his premium drops by $40 a month. $480 a year in his pocket. He feels like a genius. He thinks, I'm a good driver. I'll never get in an accident. I'm hacking the system. He signs up, high-fiving himself for being so clever. Jessica does the same thing. She sees the savings from a high deductible, and it's tempting. But before she clicks buy, she stops and asks herself one brutally honest question. It's the first step in our framework, and it's the most important. What is my sleep at night number? The sleep at night number is the amount of cash you could pull from your bank account tomorrow to pay for a surprise car repair, without it causing a full-blown panic attack. It's not how much credit you have on your card. It's not money you'd have to borrow from your parents. It's the liquid cash you could part with and still be able to pay your rent and buy groceries. Jessica looks at her emergency fund. She has about $3,000 saved. She thinks, if I had to write a check for $2,000, that would wipe out most of my savings. That would stress me out for months. But $1,000? She could handle that. It would hurt, but it wouldn't break her. Her life wouldn't be derailed. So, her sleep at night number is $1,000. That becomes her absolute maximum deductible. Dave never even asked the question. His sleep at night number was probably $500, but his ego and his desire for a cheap premium chose $2,000 for him. That's mistake number 1. Now for step 2. The premium payback calculation. This is where we do a tiny bit of math to see if the savings are actually worth the risk. Simpler than you think. Jessica compares two options. A $500 deductible costs her, say, $100 a month. The $1,000 deductible, her sleep at night number, costs $80 a month. The difference in savings is $20 a month, or $240 per year. The difference in risk, the extra cash she'd have to pay if she had a claim, is $500. So she just divides the extra risk by the annual savings. 500 divided by 240. The answer is about 2.1. This means it will take her 2.1 years of driving without an at-fault accident to break even. In other words, for that higher deductible to have actually saved her money, she needs to stay accident-free for just over 2 years. This brings us to step 3, the risk profile gut check. The math gives you a timeline, but you have to filter that through your own life. Jessica thinks about it. She has a 10-year clean driving record. She has a short, easy commute on suburban roads. She doesn't street park in a crowded city. She looks at that 2.1-year break-even point and thinks, that's a bet I'm willing to take. She chooses the $1,000 deductible, saving $240 a year and feeling confident in her decision. Now let's go back to Dave. 6 months after buying his genius policy, he's driving home in the rain. He glances at his phone for a split second and boom, he rear-ends someone at a red light. It's a low-speed crash, but the damage to his front end is significant. The repair estimate is $4,000. He calls his insurance company. They say, no problem, we'll cover it. Just pay your $2,000 deductible to the body shop, and we'll handle the rest. And Dave's heart sinks into his stomach. $2,000. He doesn't have it. He has maybe $600 in his checking account. He has to put the deductible on a high-interest credit card, instantly wiping out the $240 he would have saved for the year and putting him deep in the hole. For the next year, he's paying off that credit card bill, plus interest, all because he wanted to save $40 a month. His cheap insurance policy became the most expensive financial mistake he'd ever made. Jessica, a year later, has a different kind of luck. A deer jumps out in front of her car on a country road. It's not her fault, but the damage is severe, $5,000. She calls her insurance. They tell her to pay her $1,000 deductible. She goes to her emergency fund, writes the check, gets her car fixed and moves on with her life. It was an inconvenience, not a crisis. She made a calculated risk that was aligned with her actual financial reality. So the framework is simple. 1. Find your sleep at night number. Be brutally honest about what you can afford to pay out of pocket tomorrow. That is your non-negotiable deductible ceiling. 2. Do the premium payback calculation. Divide the extra risk by the annual savings to see how long you have to go without an accident to break even. And 3. Do a risk profile gut check. Does that break-even timeline feel like a safe bet based on your car, your commute, and your driving history? This demolishes the 2 biggest myths about deductibles. The first myth is, always pick the highest deductible to save the most money. That's what Dave did, and it ruined him. That advice is only for people with a massive, fully funded emergency fund, who can truly afford to self-insure for that amount. The second myth is, always pick the lowest deductible for peace of mind. For some people, this is true. But if Jessica had picked the $500 deductible just to be safe, she would have been needlessly spending an extra $240 every year, year after year, for a level of risk she was perfectly comfortable and financially prepared to take on herself. But hold on, because there's one more professional level secret that almost no one on the street knows about. You don't just have one deductible. You usually have 2. You have a deductible for collision and a deductible for comprehensive. And they don't have to be the same. Collision is for when your car hits something else, another car, a pole, a wall. This is the coverage that is most related to your own driving habits. If you live in a dense city with chaotic traffic and tight parking, you might want a lower collision deductible like $500 or $750 because your risk of a fender bender is higher. But comprehensive is different. This covers things that are mostly out of your control. Your car getting stolen, a tree branch falling on it during a storm, hail damage, or hitting a deer like Jessica did. Think of it as act of God coverage. Here's the pro move. You can strategically split your deductibles. You could keep your collision deductible lower, say $500 for that peace of mind in traffic. But you could raise your comprehensive deductible to $1,000 or even $1,500. If you park your car in a secure garage every night, live in an area with low crime and mild weather, the odds of you making a comprehensive claim are way, way lower. By raising just the comprehensive deductible, you can save a significant amount on your premium without taking on much realistic day-to-day risk. It's about being smart in allocating your risk where it makes the most sense. So the perfect deductible isn't a number your insurance agent gives you. It's a personal financial strategy. It's the intersection of what you can afford, what you can save, and the risks you're willing to bet on. Now you know how to set your deductible like a financial pro. But that's just one piece of the puzzle. What about the actual coverages themselves? You see this list: bodily injury liability, property damage liability, collision, comprehensive, uninsured motorist, medical payments, It's an alphabet soup of confusion. Are insurance companies just trying to upsell you on things you don't need? Do you have to get all of them? We're about to break down exactly what each one means, what you are legally required to have, what you absolutely should have to protect yourself, and the one optional coverage that could literally save you from financial ruin that almost nobody talks about. Alright, let's pull back the curtain on that cryptic piece of paper your insurance agent hands you. It looks like a foreign language, full of acronyms and numbers, but by the end of this you'll be able to read it like a pro. The foundation of every single car insurance policy in America is liability coverage. This is the big one. This is the part that's not for you at all. Liability coverage pays for the damage you cause to other people and their property. If you rear-end someone at a stoplight, this is what pays to fix their bumper and, more importantly, pays for their doctor's visit for whiplash. It's broken down into two simple parts: bodily injury liability and property damage liability. When you see those three numbers on your policy like 25/50/25, this is what they mean. The first number is the maximum amount, in thousands of dollars, your insurance will pay for a single person's injuries in an accident you cause. So, $25,000 in this case. The second number is the maximum amount they'll pay for all injuries combined in that one accident. So, $50,000. The third number is the maximum they'll pay for all property damage. That means their car, the fence you smashed through, the mailbox you knocked over. $25,000 for that. Now, here is the single most dangerous financial mistake millions of Americans make. They see that their state only requires them to have, say, 25/50/25, and they think, great, I'll get the cheapest possible plan and save some money. This is like protecting a priceless painting with a piece of tissue paper. Let's play this out. You're driving home, you glance down at your phone for just a second, and you slam into the back of a brand new Mercedes. The driver and their passenger both have serious back injuries. The Mercedes needs $60,000 in repairs. Their combined medical bills, after months of physical therapy, hit $120,000. Your state minimum policy with 50/25 coverage pays out its maximum. It pays $50,000 for their medical bills and $25,000 for their car. That leaves a $95,000 gap. And guess who pays for that? You do. The other driver's insurance company isn't just going to forget about it. They will sue you. They will come after your savings. They will garnish your wages for years. They can put a lien on your house. That 1 second of distraction, combined with a cheap insurance policy, could bankrupt you. Liability is not the place to skimp. Protecting your assets starts with having enough coverage to handle a serious, but very realistic accident. We're talking limits of at least 100/300/100 if you have a home or any significant savings to protect. Okay, so liability covers them. What covers you and your car? That's where the next two pieces come in: collision and comprehensive. They sound similar, but they're very different. Collision is simple. It pays to repair or replace your car if you hit something. It could be another car, a telephone pole, a guardrail, a garage door. If you collide with an object, this is your coverage. It doesn't matter who was at fault. Because the accident, collision fixes your car. If someone else hits you, their liability coverage is supposed to fix your car. But having your own collision coverage means your insurance company can pay you immediately and then go after the other guy's company, which is a lot faster than waiting around for them to admit fault. Comprehensive coverage is for almost everything else. Think of it as the acts of God and weird stuff policy. A hailstorm dents your entire roof? That's comprehensive. A deer jumps out of the woods and you can't avoid it? Comprehensive. A thief smashes your window and steals your car? Comprehensive. A tree branch falls on your hood during a windstorm? You guessed it, comprehensive. It covers damage not caused by a collision. For both collision and comprehensive, you'll have what's called a deductible. This is the amount you agreed to pay out of pocket before the insurance money kicks in. A common deductible is $500 or $1,000. A higher deductible means a lower monthly premium, but it also means you need to have that cash on hand if something happens. So now we've covered their car, their bodies, and your car. What about your body? What about your passengers? This is where medical payments coverage, often called MedPay, or personal injury protection, known as PIP, comes into play. Which one you can get often depends on your state. MedPay is straightforward. It covers medical expenses for you and your passengers after an accident, regardless of who was at fault. It's great for covering your health insurance deductible or copays right away. Personal injury protection, or PIP, is required in no-fault states and is more comprehensive. Not only does it cover medical bills, But it can also cover things like lost wages if you can't work after an accident, and even services you might need to hire like childcare while you recover. It's designed to get you back on your feet without a massive financial hit, even if the fault of the accident is still being argued over. Now we arrive at the one we hinted at. The single most important coverage you can buy that isn't always required. The one that can mean the difference between a full recovery and absolute financial ruin. It's called uninsured and underinsured motorist coverage. Let's go back to our accident scenario. But this time you're the victim. You're sitting at a red light, minding your own business, when a distracted driver plows into you from behind. Your car is wrecked. You have a serious neck injury requiring surgery and months of rehab. The police show up and you find out the driver who hit you has no insurance. Zero. They were driving illegally and have no assets to their name. Who pays for your totaled car? Who pays your $100,000 in medical bills? Who pays for your lost wages while you're out of work? Without uninsured motorist coverage, the answer is horrifying. You do. You are left holding the entire bag for an accident you didn't cause. It's a nightmare scenario that happens every single day. 1 in every 8 drivers on the road in America right now is uninsured. That's a terrifying statistic. Uninsured motorist coverage steps in and becomes the insurance the other driver should have had. It pays for your medical bills, your lost wages, your pain and suffering. The underinsured part is just as important. It kicks in when the at-fault driver has insurance, but it's just the cheap state minimum kind that we talked about earlier, and it isn't nearly enough to cover the cost of your injuries. Your underinsured motorist coverage pays the difference, up to your policy limits. Adding this coverage to your policy is shockingly inexpensive, often just a few extra dollars a month. And for that price, you are buying peace of mind. You are protecting yourself and your family from the irresponsible actions of a complete stranger. You cannot control if the person texting in the lane next to you has insurance, but you can control whether their mistake destroys your life. This is the one. This is the coverage you absolutely must have. So let's recap the fortress you're building. Liability protects your assets from others. Collision and comprehensive protect your car from, well, everything. MedPay or PIP protects your body and your wallet right after a crash. And uninsured/underinsured motorist coverage protects you from the massive, and frighteningly common, risk of being hit by someone who can't pay for the damage they caused. Now that you understand what each of these powerful tools does, the next critical question is how to put them together. How much is enough? Is getting just the state minimum a ticking financial time bomb? We're about to get into the specific dollar amounts you should be looking for to truly bulletproof your finances, and the answer is going to shock you. Okay, let's defuse that bomb. The single biggest mistake, the most catastrophic error an American driver can make, is believing that the legal amount of insurance is the safe amount of insurance. They are not even in the same universe. State minimum liability coverage isn't a shield. It's a piece of paper with the word shield written on it. It's designed to meet a legal requirement, not to protect you in a real-world accident. Let's take a state like California. The minimum for bodily injury is $15,000 per person and $30,000 per accident. For property damage, it's a laughable $5,000. $5,000. Can you even buy a reliable used car for that anymore? Can you fix the bumper on a new Mercedes for that? The answer is a resounding no. Relying on state minimums is like entering a sword fight with a plastic butter knife. You have technically brought a weapon, but you are going to lose badly. To understand why this is so critical, I want you to meet Alex. Alex is a good person, a safe driver, has a decent job, a small savings account, and is finally starting to get ahead. One Tuesday afternoon, Alex is driving home, maybe thinking about what to make for dinner, and glances down at a text message for just 2 seconds. But 2 seconds is all it takes. The car in front, a brand new Toyota Highlander, stops suddenly. Alex slams on the brakes, but it's too late. It's not a high-speed crash, just a solid stomach-dropping crunch of metal and glass. Everyone seems okay at first, a little shaken up. The Highlander has a crumpled rear end. Alex's older sedan is totaled. They exchange information. The other driver is a mother with her 2 teenage kids in the car. Alex has the state minimum insurance and thinks, okay, this is what I pay for. My insurance will handle it. This is the moment Alex's financial life begins to unravel. A week later, the calls start. The Highlander, it turns out, is a $50,000 vehicle. The repair estimate comes back at $28,000, but because of frame damage, the insurance company declares it a total loss. Alex's state minimum property damage coverage is $5,000. So the insurance company writes a check for $5,000 and says, "We've fulfilled our legal obligation. Good luck." The other driver's insurance company now comes after Alex personally for the remaining $45,000. 45 grand. Gone. That's the first hit. But it gets so much worse. Remember how everyone seemed okay? Well, the mother who was driving now has severe whiplash and 2 herniated discs in her neck. She needs months of physical therapy, chiropractic care, and might need surgery. Her medical bills, after her health insurance pays its part, are already at $40,000 and climbing. Plus, she's a freelance graphic designer and can't work while she's in pain. She's claiming $20,000 in lost wages. That's $60,000 for just one person. Her son in the front seat hit his head on the side window. He had a concussion, forcing him to miss the last month of the school year and drop out of the baseball season. His medical bills for the ER visit, MRI, and follow-up neurology appointments are $15,000. The daughter in the back has a fractured wrist from bracing for impact. The cast, the doctor visits, the specialist, that's another $10,000. So let's do the math. We have $60,000 for the mom, $15,000 for the son, $10,000 for the daughter. That's a total of $85,000 in medical bills and lost wages. Alex's state minimum bodily injury coverage is $15,000 per person, with a maximum of $30,000 per accident. So the insurance company writes a check for $30,000, the absolute max they are legally required to pay, and once again they wash their hands of the situation. Alex is now personally on the hook for the remaining $55,000 in medical costs, plus the $45,000 for the car. That's $100,000. A 6-figure debt, created in 2 seconds of distraction. Alex's savings are wiped out in an instant. But it doesn't stop there. Because Alex can't just write a check for $100 grand. The family's insurance company hires a lawyer and sues. And they don't just sue for the $100,000. They sue for pain and suffering. For the son's missed opportunities. For the mother's chronic pain. The lawsuit is for $500,000. Alex has to hire a lawyer, which costs thousands more. The court case drags on. Eventually, the judge rules in favor of the family. Alex now has a legal judgment of hundreds of thousands of dollars. What happens next? Wage garnishment. The court orders Alex's employer to take a percentage of every single paycheck, often up to 25%, and send it directly to the victims. For years, for decades, Alex's dream of buying a house? Gone. Saving for retirement? Impossible. That 1-2-second mistake, backed by a legal but worthless insurance policy, has resulted in a lifetime of financial ruin. This story isn't an exaggeration. It happens every single day in America. So what is the answer? How do you build a real fortress around your life? You do it with something called 100/300/100. Write that down. 100/300/100. This is widely considered by financial experts to be the real minimum level of protection you should have. Let's rewind the clock on Alex's accident. But this time, Alex has 100/300/100 coverage. The first number, 100, stands for $100,000 in bodily injury liability per person. When the mother's medical bills and lost wages hit $60,000, this coverage would have paid for all of it. No lawsuit, no out-of-pocket cost. It's covered. The second number, 300, stands for $300,000 in bodily injury liability per accident. This is the total pool of money available if multiple people are hurt. The mother's $60,000, the son's $15,000, the daughter's $10,000, that's $85,000 total. The $300,000 limit easily covers all of it. Again, no lawsuit. The insurance company handles it. And that third number, 100, stands for $100,000 in property damage liability. That $50,000 Highlander that was totaled? The policy would have paid the full amount. It would have even covered the cost to repair the city guardrail that was also damaged in the crash. Alex wouldn't have paid a single dime. With 100/300/100 coverage, Alex's story changes completely. Instead of a life-altering financial catastrophe, it's just a bad day. Alex files the claim. The insurance company pays for the other family's injuries and their totaled car, and that's it. Alex's savings are safe. Alex's future is secure. The wages are not garnished. Life goes on. You might be thinking, that sounds expensive. But the difference in premium between the state minimum death trap and a 100/300/100 policy is often just a few $100s a year. Maybe the cost of a couple of fancy coffees a month, You are trading a tiny, manageable, predictable expense for protection against absolute, unpredictable ruin. It is the single highest return investment you can make in your financial security. Some experts even recommend going higher to 250/500/100, especially if you have significant assets to protect like a home. Protecting other people from your mistakes is the foundation of car insurance. But this is only half of the equation. We've spent all this time talking about what happens when you're at fault and you need to pay for their car and their medical bills. But what about your car? What about your medical bills? And what happens if the person who hits you is just like the first version of Alex, driving around with that ticking time bomb of a state minimum policy? Or even worse, what if they have no insurance at all? That's when your policy has to pivot from being a shield that protects others to a safety net that catches you. And the two types of coverage that do this are the most critical and most confusing parts of any policy. They are called uninsured and underinsured motorist coverages, and they answer the sixth and arguably most terrifying question on our list. What happens if the person who hits me has little or no insurance? To understand this, let's imagine a scenario. Let's call our driver Sarah. Sarah is meticulous. She pays her bills on time, she saves for retirement, and she's proud of the fact that she has full coverage on her car. One afternoon, she's waiting at a red light, humming along to the radio when bam, a car slams into her from behind. It's a serious jolt. Her neck is killing her, her bumper is now somewhere in her trunk, and the other driver, looking shaken, gets out and admits it was completely his fault. He was texting. After the police report and the tow truck, Sarah calls her insurance company, confident. "I have full coverage," she tells the agent. "The other guy was at fault, but I just want to get the ball rolling." The agent asks for the other driver's insurance information. Sarah provides it. A day later, the agent calls back with horrifying news. The other driver's policy had lapsed. He had zero insurance. He was, in the eyes of the law, an uninsured motorist. Sarah's heart sinks. She thinks, "Okay, but I have full coverage. You guys will cover my medical bills and fix my car, right?" And this is the moment of truth. The point where millions of Americans discover a devastating gap in their understanding of insurance. The agent explains that her liability coverage, the part that's legally required, is only for damage she causes to other people. It does nothing for her. Her collision coverage can fix her car, but she'll have to pay her $1,000 deductible first for an accident that wasn't her fault. And as for her mounting medical bills, the ER visit, the x-rays, the physical therapy she's going to need for whiplash, her standard policy has no built-in way to pay for that. This is the nightmare scenario. You did everything right, and you're left holding the bag for someone else's irresponsibility. Unless you have uninsured motorist coverage. Uninsured motorist, or UM coverage, is your personal financial bodyguard. It steps in and acts like the insurance the other driver should have had. It's not one thing. It's typically split into two critical parts. First, there's uninsured motorist bodily injury, or UMBI. This is the hero of our story. This coverage pays for your medical expenses when you're hit by an uninsured driver. It covers you, your family members, and anyone else in your car at the time of the accident. And it doesn't just stop at ER bills. It can cover lost wages if you can't work because of your injuries. It can cover long-term physical therapy, chiropractic care, and even that most intangible but very real cost, pain and suffering. Think of it this way. You are essentially buying an insurance policy for the millions of irresponsible drivers out there, just in case one of them crashes into you. You're paying a little extra each month to make sure there's a safety net, even when the other person cut theirs to pieces. Second, there's uninsured motorist property damage, or UMPD. This, as the name implies, covers the damage to your car. In our story, this is what would pay to fix or replace Sarah's car without her having to pay her collision deductible. Now, this coverage gets a little tricky. Some states don't offer it, requiring you to use your own collision coverage instead. But in states that do offer it, it's a fantastic option. It saves you from paying hundreds or even thousands of dollars out of pocket for a deductible on a claim that was 100% not your fault. It keeps your own claim history cleaner and prevents your rates from potentially going up because you had to file a collision claim. So, uninsured motorist coverage protects you from the driver with no insurance. But what about the other, even more common scenario? What about the driver who has insurance, but only the bare minimum required by law? Let's change our story slightly. The guy who hit Sarah does have insurance, but he lives in a state where the minimum bodily injury liability is only $15,000 per person. That sounds like a lot of money until you get a hospital bill. Sarah's injuries are serious. After an ambulance ride, an MRI, and consultations with a specialist, her medical bills quickly soar to $60,000. And she's going to be out of work for 2 months, losing another $10,000 in income. Her total damages are $70,000. The at-fault driver's insurance company cuts a check for $15,000. That's it. That's all they are legally obligated to pay. They've met the limits of their policy. So where does the other $55,000 come from? Does Sarah have to sue the driver personally? She could, but if he can only afford minimum limit insurance, the odds of him having $55,000 in assets are slim to none. This is financial quicksand. This is where the second hero comes in. Underinsured motorist coverage, or UIM. Underinsured motorist coverage is the big brother to uninsured motorist coverage. It activates when the at-fault driver has insurance, but their liability limits aren't high enough to cover your bills. It bridges the gap. It pays the difference between the other driver's low limit and the full cost of your damages, up to the UIM limit you selected on your own policy. So in Sarah's case, the other driver's policy paid out its $15,000 max. Her own UIM coverage would then step in to cover the remaining $55,000. Without it, she would be facing financial ruin. With it, she's made whole. She can focus on her recovery, not on bankruptcy filings. Now you might be thinking, this all sounds like a rare worst-case scenario, but it's not. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. That's nearly 13% of cars around you at any given moment. In some states like Mississippi, it's 1 in 4. In Florida, it's 1 in 5. You are sharing the road every single day with millions of people who have no way to pay for the damage they might cause you. Opting out of UM and UIM coverage is like walking a tightrope with no safety net, hoping that every other acrobat on the rope with you is as careful as you are. It's a massive gamble. The most common piece of advice from financial experts and insurance insiders is this: your uninsured and underinsured motorist coverage limits should be an exact mirror of your own bodily injury liability limits. If you have $100,000 of liability coverage to protect others from you, you should have at least $100,000 of UIM coverage to protect you from others. Why would you value a stranger's financial well-being more than your own? Why would you carry enough insurance to protect their assets, but not enough to protect your own health, your own ability to earn an income, your own family's future? So I urge you to do something right now. Pause this video, grab your insurance policy declaration page, and look for 2 sets of letters, UM and UIM. Find them. See the dollar amounts next to them. If you see rejected or waived, you need to call your agent today. If you see a number that's lower than your liability limit, you need to call your agent today. The cost to add or increase this coverage is often shockingly small, sometimes just a few dollars a month, but the protection it provides is immense. It is one of the single most important decisions you can make to safeguard your financial life. It protects your body, it protects your car, it protects your savings. But what happens in a situation that's even murkier? What if you're in a hit and run, and you never even see the other driver, let alone their insurance card? Or what if the accident is your fault? UM and UIM won't help you then. Who pays for your initial hospital bills in those cases, before the lawyers and liability have been sorted out? That's where a different, often misunderstood, type of coverage comes into play, and it answers our 7th question. What is medical payments or personal injury protection, and do I really need it if I have health insurance? Picture the scene. The crash is over. The adrenaline is fading, replaced by a throbbing pain in your neck and a sharp ache in your wrist. The paramedics are there, and they're recommending a trip to the emergency room just to be safe. You agree. You're loaded into the ambulance, the sirens wail, and you spend the next few hours getting x-rays, seeing a doctor, and eventually getting a prescription for pain meds and a wrist brace. You go home, shaken but thankfully not seriously injured. Then, a week later, the first bill arrives. It's from the ambulance company. It's for $900. A few days after that, the bill from the hospital's emergency room lands. It's for $3,000. And you haven't even gotten the bill from the radiologist who read your x-rays yet. You know the other driver was at fault, and you filed a claim with their insurance. But their adjuster is still investigating the incident. They haven't accepted liability yet. They might not for weeks. Meanwhile, these bills have due dates. Your own health insurance will cover some of it, sure, but you have a $2,000 deductible you have to pay out of pocket first. So you're staring at thousands of dollars in immediate expenses for an accident you didn't even cause. The stress is immense. This exact situation is why medical payments coverage, or MedPay, and its more powerful cousin, personal injury protection, or PIP, exist. They are the financial first responders for your body. Let's start with MedPay. Think of it as a small, dedicated emergency fund for medical bills that's built right into your car insurance policy. The key thing to understand about MedPay is that it pays out regardless of who is at fault. It doesn't matter if you caused the accident, if the other guy did, or if a deer jumped out of nowhere. If you are injured in your car, or even as a pedestrian hit by a car, MedPay kicks in immediately. Covers you, and just as importantly, it covers the passengers in your car. It pays for things like that ambulance ride, the ER visit, doctor copays, x-rays, chiropractic care, even dental work if you chipped a tooth on the steering wheel. It's designed to be fast. There's no waiting for adjusters to argue for weeks about who ran the red light. You submit the bill, and your insurance pays it right up to the limit you chose, typically something like $5,000 or $10,000. It's a financial band-aid that stops the immediate bleeding, so you can heal without the added stress of collection notices. Now let's talk about the supercharged version, personal injury protection, or PIP. If you live in one of the dozen or so no-fault states like Florida, Michigan, or New York, you are required to have this. In a no-fault state, the law says that your own insurance is the primary payer for your injuries up to a certain limit, no matter who is at fault. The whole point is to speed up the payment process and keep smaller injury claims from clogging up the court system. And PIP coverage is broad. It covers everything MedPay does, the ambulance, the hospital, the doctors, but it adds two absolutely game-changing benefits: lost wages and essential services. Imagine you're a freelance graphic designer and you break your arm in a car wreck. You can't use your computer, you can't work, and you can't earn money for 6 weeks. PIP can pay you a percentage of your lost income while you recover. This is a lifeline. It can be the difference between a stressful recovery and a financially devastating one. Or let's say you're a stay-at-home parent with 2 young kids, and you suffer a bad concussion. You can't safely care for your children. PIP can help pay for childcare. If you can't clean your house or mow your lawn because of your injuries, it can help pay for those essential services too. It's designed to help you maintain your life while you get back on your feet. Right now, I know exactly what half of you are thinking. It's the single biggest question about this coverage. This all sounds great, but I have good health insurance. Isn't paying for MedPay or PIP just paying for the same thing twice? It is a fantastic question, and the answer is an emphatic no. They are not the same thing. Thinking your health insurance is a perfect substitute for MedPay or PIP is one of the most common and costly mistakes a driver can make. Here's why. First, deductibles, copays, and coinsurance. Almost every health insurance plan has them. That initial shock of bills from the ambulance and the ER? Your health insurance won't pay a dime until you've met your deductible, which can be thousands of dollars. MedPay or PIP can be used to pay for that deductible and your copays. Let me repeat that. Your car insurance can pay your health insurance deductible. Your MedPay coverage acts as the bridge, covering those immediate out-of-pocket costs and keeping your savings account untouched. Second, network restrictions. Your health insurance plan likely has a network of approved doctors and hospitals. But after a car accident, you might need a specific type of specialist, like a neurologist who specializes in concussions or a physical therapist who focuses on whiplash. What if the best one in your area isn't in your health plan's network? You're stuck paying exorbitant out-of-network rates. MedPay and PIP don't have networks. They pay for any reasonable and necessary medical treatment related to the accident, giving you the freedom to choose the best care for your recovery. Third, and this is the big one, passengers. Your health insurance policy covers exactly one person, you. It does nothing for your friends, your family, or your colleagues riding with you. Imagine you're driving your buddy to a football game and you get into an accident. Your friend breaks his wrist. His health insurance has a $5,000 deductible. Are you prepared to look your friend in the eye and say, "Sorry man, hope you can cover that"? It's an awful friendship-straining position to be in, but if you have MedPay or PIP, it covers everyone in the car. It protects your passengers. It's a simple, inexpensive act of responsibility that says, if you're riding with me, you're covered. So how much does this peace of mind cost? You'd be shocked. For MedPay, we're often talking about the price of a couple of lattes a month. It is typically one of the least expensive coverages you can add to your policy. PIP is more expensive because its benefits are so much broader, and in no-fault states, it's a required part of the premium you're already paying. Ultimately, MedPay and PIP are not a replacement for health insurance, and health insurance is not a replacement for them. They work together as a team. Health insurance is for your general well-being, colds, checkups, and long-term health. MedPay and PIP are specialists. They are car accident-specific financial tools designed to fill the exact gaps your health insurance leaves open, protecting your health, your wallet, and your relationships in the chaotic moments after a crash. So we've covered your medical bills and even your lost wages. But as you're sitting at home recovering, you look out the window and see your mangled car sitting in the driveway. Who pays to fix that? This brings us to the most famous duo in car insurance, and the subject of our 8th question. What is the difference between collision and comprehensive insurance? And more importantly, do you actually need both? This is, without a doubt, one of the most common points of confusion in the entire world of insurance. People hear these two words thrown around together so often, they think they're the same thing. They are not. Think of them as two different bodyguards for your car, each one protecting it from a very specific set of dangers. Let's start with collision. The name says it all. Collision coverage pays to repair or replace your car after it's damaged in a collision with another object. That other object is usually another car, but it could also be a streetlight, a guardrail, a fire hydrant, or your own garage door that you forgot to open. We've all been there. The most important thing to remember about collision is that it pays out regardless of who is at fault. If someone runs a red light and T-bones you, their liability insurance should cover your car. But what if they're uninsured? Or what if their coverage limits are too low to replace your new SUV? That's where your own collision coverage steps in to save the day. But it also covers you when you are the one who messes up. Let's say you're in a crowded parking lot, you're backing out, you misjudge the distance, and crunch, you hit one of those concrete pillars. Your fault. Your bodily injury and property damage liability won't pay a dime to fix your own car. That's not what they're for. But your collision coverage? It will. Now, before you get a check, you have to pay your deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. Deductibles for collision typically range from $250 to $1,000, or even more. Let's say you have a $10,000 repair bill and a $1,000 deductible. You pay the first $1,000, and the insurance company pays the remaining $9,000. The higher your deductible, the lower your premium will be, because you're agreeing to take on more of the financial risk yourself. So, to put it simply, collision is for when your car hits something or something hits your car. It's the clumsy coverage, the oops coverage. Now let's talk about its partner, comprehensive. This is the one that causes the most confusion. Insurance companies often call it other than collision coverage, which is actually a much better name for it. Comprehensive protects your car from just about every other bad thing you can imagine that isn't a collision. This is the coverage for the chaotic, the unpredictable, the acts of God, and the acts of criminals. A tree branch falls on your car during a windstorm? That's comprehensive. A freak hailstorm makes your hood look like the surface of the moon? Comprehensive. You're driving down a country road at dusk, and a deer decides to redecorate your front bumper? Comprehensive. It also covers theft. You walk out to your driveway in the morning and your car is just gone, vanished. That gut-wrenching feeling is followed by a call to your insurance company, where you'll file a comprehensive claim. It also covers vandalism, someone keying your car, slashing your tires, or breaking a window. It covers fire, floods, earthquakes, riots. Basically, if it's a disaster movie plot, it's probably covered by comprehensive. Just like collision, comprehensive coverage has a deductible that you have to pay first. And often, you can choose different deductible amounts for each coverage. You might want a lower deductible for comprehensive, because things like a cracked windshield are more common and less expensive to fix than a full-on collision. So that's the difference. Collision is for crashes. Comprehensive is for chaos. Now for the multi-$1,000 question. Do you actually need them? The short answer is, it depends. First, let's get the easy one out of the way. If you have a loan on your car or you're leasing it, the answer is almost certainly yes. In fact, it's not even your choice. Your lender or leasing company will require you to carry both collision and comprehensive. Why? Because until you pay it off, they technically own the car. It's their asset, and they are not about to let you crash their multi-$1,000 asset without a way to get their money back. They need to protect their investment, and you're the one who has to pay the premium for that protection. Once the car is paid off, the title is in your name, and the decision becomes yours and yours alone. And this is where most people get stuck. You have an older car. It's paid off, It runs great, but it's not worth a ton of money. Are you just throwing money away every month paying for collision and comprehensive? To answer that, you need to understand one of the most important concepts in insurance: actual cash value, or ACV. When your car is totaled in an accident, the insurance company doesn't pay you what it would cost to buy a brand new 2024 model. They don't pay you what you think your car is worth because of all the memories you've made in it. They pay you what your car was worth the second before the accident happened. That's the actual cash value. It's the replacement cost minus depreciation. And cars depreciate fast. That car you bought for $30,000 5 years ago might only have an ACV of $12,000 today. A 10-year-old car you bought for $20,000 might only be worth $4,000 now. So here's the practical math test you need to run to decide if you should keep these coverages. Step 1. Find your car's actual cash value. Don't guess. Go to a site like Kelley Blue Book or Edmunds, enter your car's year, make, model, mileage, and condition honestly. This will give you a solid estimate. Step 2. Look at your insurance policy and find your collision and comprehensive deductibles. Let's say your car's ACV is $4,000 and your collision deductible is $1,000. Step 3. Subtract your deductible from the ACV. In this case, $4,000 minus $1,000 is $3,000. This number, $3,000, is the absolute maximum amount your insurance company would ever pay you if your car were totaled. Step 4. Look at how much you're paying per year for that specific coverage. Call your agent and ask them to break it down. Let's say you're paying $600 a year for collision and comprehensive. Now you can make an informed decision. Is it worth paying $600 a year for a maximum potential payout of $3,000? For many people, the answer is yes. That's a pretty good safety net. But what if your car is older? Let's say its ACV is only $2,000. Your deductible is still $1,000. The maximum payout you could ever receive is now only $1,000. And you're still paying $600 a year for the coverage. You're essentially paying $600 to protect a $1,000 risk. The math is starting to look a lot less appealing. If your car's value is less than your deductible, you're getting literally zero benefit from the coverage. You're just setting money on fire. A good rule of thumb many financial experts use is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, it might be time to consider dropping it. In our last example, 10% of the $2,000 car is $200. Since the $600 premium is way more than that, it's a strong candidate for removal. But math isn't the only factor. The final piece of the puzzle is your personal financial situation and your tolerance for risk. Ask yourself this brutally honest question. If my car was totaled tomorrow, could I afford to repair or replace it with cash from my savings without causing a major financial crisis in my life? If the answer is no, then keeping the coverage even on an older car might be the right call. It's a peace of mind payment. You're paying the insurance company to take on a risk that you can't afford to take on yourself. But if you have a healthy emergency fund and could easily buy another $2,000 car to get you around, then you might choose to self-insure by dropping the coverage and putting that $600 a year into your savings instead. So, you've figured out what liability limits you need. You've decided on your medical coverages. And now you know exactly how to determine if you need collision and comprehensive. You've built the perfect policy for your needs. But when the bill comes, you get a nasty surprise. It's way more expensive than you thought. This leads us directly to our 9th question, and it's the one that makes every American driver's blood boil at some point. Why is my car insurance so expensive? It's a question that echoes in millions of American households every 6 months. You open that email, you see that number, and you feel this hot mix of confusion and anger. You're a good driver. You haven't had an accident in years. So why does it feel like you're being punished? Why are they charging you a small fortune just for the legal right to drive the car you already own? To understand the answer, you have to understand the fundamental game being played. Car insurance at its core is a massive nationwide bet. The insurance company is the house, and they are betting that you will pay them more in premiums than they will ever have to pay out for you in claims. You, on the other hand, are betting that you might need them to pay for a catastrophic event you can't afford on your own. Your premium, that number that makes you want to throw your phone across the room, is simply the price the house sets on your specific bet. And they don't guess. They use a staggering amount of data and complex algorithms to calculate the odds on you. They are professional risk assessors, and they've broken down your life into a series of risk factors. Let's pull back the curtain and look at exactly what they see. First, they look at you, the driver. This is the most personal part of the equation. Your driving record is the big one, the headline on your risk profile. Every speeding ticket, every at-fault accident, every DUI is a bright red flag to an insurer. Think of it this way, for 5 years you're a perfect driver. In their eyes, you're a 1% risk. Then, you get one speeding ticket for going 15 over. To you, it's a simple mistake. To them, the algorithm now sees you as someone capable of making that mistake. Your risk profile might jump from 1% to 5%. That's a 400% increase in their perceived risk, and your premium will reflect that. They aren't insuring the driver you were yesterday. They are insuring the driver you proved you could be today. But here's a factor that shocks most people: your credit score. You're probably thinking, what on earth does my Visa bill have to do with my ability to merge onto a highway? It's a fair question. The answer, according to decades of insurance data, is a lot. Insurers have found a strong statistical correlation, showing that people with lower credit scores file more claims. It's not a judgment on your character. The data suggests it might be linked to financial stress, or perhaps a tendency to put off regular car maintenance, leading to mechanical failures that cause accidents. Whatever the reason, the correlation is so strong that in most states, your credit history can impact your insurance rates as much as a minor accident. It's the financial responsibility factor, and it counts for a lot. Then there are the things you can't control, like your age and, in some states, your gender. This is where it feels really unfair. A 20-year-old male will, on average, pay dramatically more than a 40-year-old female, even with identical cars and clean records. Why? Because statistically, young men as a group are the riskiest drivers on the road. They get into more accidents, more serious accidents, and engage in riskier behavior behind the wheel. You might be the most responsible 20-year-old on the planet, but you're being priced based on the combined behavior of millions of your peers. The house is playing the odds, not betting on you as an individual. And the biggest factor you can't control? Your zip code. Where you park your car at night is one of the most powerful drivers of your insurance rate. If you live in a dense urban area with high traffic, high crime rates, and a history of frequent claims, your premium will be higher. If you move from a quiet, rural town to the heart of Miami or Los Angeles, your insurance could literally double overnight, without you changing a single thing about yourself or your car. It's because the risk around you has changed. The chances of your car being stolen, vandalized, or hit in a parking lot have just skyrocketed, and your premium will skyrocket with it. Next, the algorithm looks at your car. The make, model, and year of your vehicle are critical. This isn't just about how much the car is worth. It's about how much it costs to fix. A new bumper for a 10-year-old Ford Focus might cost a few $100s. A new bumper for a brand new Mercedes, loaded with sensors, cameras, and radar for its driver assist systems, could cost thousands of dollars to replace and recalibrate. You're not just insuring a piece of metal. You're insuring a sophisticated piece of technology. They also look at theft rates. Is your car a popular target for thieves? Honda Accords and full-size Ford pickups are consistently among the most stolen vehicles in America. If you own one, the risk of a theft claim is higher, and therefore your comprehensive coverage will cost more. And finally, they look at safety ratings. This one is a double-edged sword. A car with top-tier safety features is great at protecting you and your passengers, which can lower the potential cost of medical claims. But, as we just discussed, all that safety tech is incredibly expensive to repair, which can drive up the cost of collision claims. Finally, the algorithm looks at the choices you made when you bought the policy. This is the part you directly control. What are your coverage limits? If you chose the bare minimum liability coverage required by your state, your premium will be low. But if you have significant assets to protect and chose high liability limits, say $500,000, you are asking the insurance company to take on a much bigger potential risk. More risk for them means a higher price for you. And what about your deductible? Your deductible is the amount you agree to pay out of pocket before the insurance company pays a dime. If you choose a low deductible, like $250, you're telling the insurer you want them to cover almost everything. That makes you more likely to file small claims for minor dings and scratches, which makes you a higher risk. If you choose a high deductible, like $1,000 or $2,000, you are taking on more of the initial financial burden yourself. The insurer loves this. It means you'll only file a claim for serious damage. Less risk for them equals a lower premium for you. But there's one more layer to this. Even if you do everything right, you have a perfect record, great credit, a safe car, and a high deductible, you've probably still seen your rates creep up year after year. This is because of the invisible forces that affect the entire insurance industry. The cost of everything is going up. Inflation means the price of auto parts, from fenders to microchips, is higher. A shortage of skilled mechanics means labor costs are at an all-time high. The cost of healthcare is soaring, so the medical bills from an injury accident are more expensive than ever before. And finally, we live in an increasingly litigious society. The sheer size of lawsuit settlements after a major accident has exploded, and insurers have to price that massive, uncertain risk into every single policy they sell. So when you get that bill, you're not just paying for your own potential mistakes. You're paying for the rising cost of car parts in a factory overseas. You're paying for the rising cost of an MRI at your local hospital. You're paying for the risk of a multi-million-dollar lawsuit happening to someone else in your state. You are a single participant in a massive interconnected web of risk, and your premium is your tiny piece of that gigantic cost. It's a complex and often frustrating system. Understanding all these factors is the first step. It transforms you from a confused customer into an informed consumer. You now know why it costs what it does. You understand the game. But understanding the rules is only half the battle. The other half is learning how to play the game to your advantage. And that brings us to the final, most empowering question of all. How can I systematically and significantly lower my car insurance premium? Not by a few dollars, not by skipping your morning coffee, but by hundreds, maybe even thousands of dollars a year. How do you stop being a passenger in this process and get in the driver's seat of your own policy? This isn't about finding one magic trick. It's about understanding that your insurance premium is not a fixed price tag. It's a negotiation. It's a complex equation, and for the last 9 questions we've been learning the variables. Now we learn how to solve for X, where X is the money that stays in your pocket. Let's start with the story. Let's call her Sarah. Sarah is a good driver, lives in a decent neighborhood, and drives a reliable 5-year-old sedan. Her renewal notice came in the mail, and her premium went up. Again, for no reason. She did what everyone says you should do. She called her agent, asked for discounts, and they knocked a whole $20 off. Whoopee. Frustrated, she spent a weekend plugging her info into a dozen different quote websites, getting a flood of spam calls and a sea of confusing numbers that were all basically the same. Sarah felt powerless. She was playing their game, but she didn't know the real rules. The first secret Sarah learned is that the common advice is often incomplete. The real leverage isn't in what you do, but when and how you do it. So let's arm you with the 5 master keys that unlock lower premiums. These are the strategies the insurance industry understands, but rarely advertises. The first key is what I call the proactive shopper's advantage. The common advice is shop around. The secret is when you shop. Most people wait until the week their policy is about to expire. This signals to insurers that you're desperate, you're rushed, and you're more likely to accept a higher rate just to be covered. It's a red flag. The pros, the people who get the best rates, shop for insurance 15 to 30 days before their current policy expires. Why? Because insurance companies have data on this. Their algorithms see a shopper looking for quotes 3 weeks in advance as responsible, meticulous, and a lower risk. They literally offer these early shoppers a better price than the person who shops 3 days before renewal. It's the same person, same car, same record, but a different price based entirely on the timing. Furthermore, this demolishes the myth of the loyalty discount. In today's market, loyalty is often penalized. Your insurer knows you're a captive customer, and they slowly inch your rates up year after year, betting on the fact that it's too much of a hassle for you to leave. Don't fall for it. Set a calendar reminder 1 month before your renewal date. That's your power window. The second master key is the financial fingerprint. We've been conditioned to believe car insurance is all about our driving. Speeding tickets, accidents, sure. But here's the uncomfortable truth they don't put in the commercials. In almost every state, one of the biggest factors in your premium is your credit-based insurance score. It's a version of your credit score, tailored for them. You could have a driving record as clean as a surgeon's scalpel, but if your credit score is struggling, your premium will be sky high. Their data across millions of people shows a statistical correlation between lower credit scores and a higher likelihood of filing a claim. It's not fair, it's not intuitive, but it is the system we operate in. So how do you fight back? You take control of your credit. This isn't just about insurance. This is a life upgrade. Get your free credit report. Dispute any errors you find. 1 in 5 reports has a mistake. Pay every bill on time, even if it's just the minimum. And try to lower your credit card utilization. That's the percentage of your available credit that you're using. Paying down a credit card from 90% full to 30% full can have a dramatic impact on your score, and consequently, a dramatic impact on your insurance premium. Improving your financial health is one of the most powerful levers you can pull to lower your insurance costs for the long term. Now for the third key, the discount stacking strategy. Asking, "Do you have any discounts?" is amateur hour. That's like walking into a restaurant and asking, "Do you have food?" You need to be a detective. You need to know which questions to ask. Start with the obvious. Bundling home or renter's insurance with your auto policy. That's usually a big one, but then go deeper. Ask about affinity groups. Are you a member of a credit union, a university alumni association, a professional organization for teachers, engineers, or nurses? Are you an active or retired member of the military? Do you belong to a wholesale club like Costco or Sam's Club? All of these organizations often have partnerships with insurance carriers that unlock hidden, significant discounts. Next, ask about a defensive driving course discount. For the cost of a few hours of your time and maybe $25 for an online course, you can often secure a 5% to 10% discount that lasts for 3 years. Do the math. If your premium is $2,000 a year, a 10% discount is $200. That's a $600 return on a $25 investment. That's an ROI that would make a Wall Street trader blush. And in our new world of remote work, explicitly ask for a low mileage discount. If you're driving less than 7,500 miles a year, you are a much lower risk. Don't let them just assume you have a standard commute. Prove it to them. The fourth key is the coverage audit. This is where you stop paying for things you don't need. The biggest one is for older cars. If you have a car that's paid off and is worth only a few $1,000s, you need to seriously question why you're still paying for collision and comprehensive coverage. Here's the rule of thumb the experts use. If the annual cost of your collision and comprehensive coverage is more than 10% of the cash value of your car, it's probably time to drop it. Let's say your car is worth $3,000. Your deductible is $500. The most the insurance company will ever pay you is $2,500. If your collision and comprehensive coverage costs you $400 a year, you're paying a huge premium for a relatively small potential payout. You're better off taking that $400, putting it in a savings account, and self-insuring against damage to your own car. You're still covered for liability, the damage you do to others, which is the most important part. Similarly, look at your deductible. A deductible is what you pay out of pocket before the insurance kicks in. The lower your deductible, the higher your premium. Raising your deductible from $250 to $1,000 can reduce your premium by 15% to 30%. It's a calculated risk. It means you need to have that $1,000 available in an emergency fund. But if you do, you are essentially betting on yourself to be a good driver, and you get paid for that bet every single month. And that brings us to the fifth and final key. The most modern, most powerful, and for some, the most controversial way to seize control of your rate, the telematics gambit. You've seen the ads for them. Progressive Snapshot, Allstate's DriveWise. Little plug-in devices or smartphone apps that track your driving habits. They measure things like heart braking, rapid acceleration, the time of day you drive, and how many miles you drive. For years, many of us have resisted this. Feels like Big Brother in your glove compartment. But it's time to reframe that. For a good driver, telematics is not a leash. It's a weapon. It is your single best tool to fight back against the old, unfair metrics. The insurance company no longer has to guess if you're a good driver based on your age, your zip code, or your credit score. With telematics, you are providing them with indisputable proof. You are showing them in real time that you are a low-risk client. And for that proof, they will reward you with their absolute best rates, sometimes cutting your premium by up to 40%. It's a voluntary trade. You give them data, they give you a massive discount. If you are a safe, responsible driver who mainly drives during the day and doesn't treat every green light like a drag race, this is the ultimate hack. You are using their own technology to bypass their outdated, biased algorithms and force them to rate you on what actually matters: how you drive. So let's go back to Sarah. Armed with this knowledge, she didn't just call her agent. She checked her credit report and found an error, which she had corrected. She set a calendar reminder and started shopping 3 weeks before her renewal. She made a list of her alumni association and her professional group and specifically asked for those affinity discounts. She raised her deductible to $1,000, confident in her emergency fund. And finally, she agreed to try a telematics program for 6 months. The result? Her premium didn't just go down. It was cut by 38%. The power was back in her hands. This is the final lesson. Car insurance isn't something that just happens to you. It's a system. And now you know how it works. You know the questions to ask, the levers to pull, and the secrets to unlock. You are no longer just a driver. You are an informed consumer, an advocate for your own wallet, and the master of your own policy. Now go take control.